Hello, agents. Hello, everyone. So welcome to today. It's 4.11 10-year treasury. So we've had a complete reversal, not a complete reversal. We had a big reversal from that 3.8. So it's back to 4.11. That should stabilize interest rates going forward into the next month, hopefully leaving everything level. And the ones that made big drops should come back. But today we're going to talk about how to not invade principal, or what the actual true withdrawal rate you can do currently. It's $38,811. You can get that for 40 years without ever touching principal. So let's take a look at this and explain it better. So we're going to look at this is using a deferred annuity. And this came from just someone who called recently and was asking some questions. So I thought I'd put this out. So this quote details are based on the California non-qualified premium rates as of 1/17, subject to change. It's for illustration purposes only. Obviously, it's a sample. And this product is based in California. So limitations and features can vary by state. Just wanted to say that really quick. So here's a person at age 60 who deposits $1 million into this MYG annuity. And they withdraw $38,811 annually each year, starting, right after the first year, like in the end of the first year. So as you can see here, what happens is after 10 years, this is a 9-year surrender charge in California. So after 10 years, you're fully liquid, as you can see here, fully liquid after 10 years, and you've been receiving this $38,000. So all columns match, it's fully liquid. After 40 years, you have $1 million. So you've been taking $38,811, and assuming you don't die and you're still alive at 100, you'll still have $1 million in your account. Now, after this, it's going to start invading principal after age 100, right? And this is all based on a 5.45 interest rate with a 3% minimum guarantee. And this is why I say the minimum guarantee is the strongest guarantee in the contract, because look what it does here. You can take 38 because you got this 3% kicking out, no 1%, right? Also, this is a commission product, not a fee-based product. So you're not paying 40 years of fees too, whereas this thing is out of surrender in the 10th year, and that's it. It all goes to the client. It's client's making all the gain on that. So let's look at $40,000. And what happens if you go to 40,000? Well, you wind up with only 90% at age 80, right? You're still liquid in the your $1 million is at 91 instead of 100. So and then you have 907,000 at the end. So there's your 90. If you make it to age 100, that's 90% of your million. But if you go back, you're at age 91, you still have your million if you're still alive. And should you pass away, right? Why? Because the annuity value is the death benefit in all those columns, right? The annuity value is full death benefit. So let's say this person died in year 26 at age 86. Their heirs would get $1,051,000 back, right? So it's actually more than the initial deposit they put in, right? So that's how that works. And that's why this is so strong, because you can go through each one of these pages and see what the annuity value is. And of course, the surrender annuity value match after the 9th year in California, 10th year in other states. So that's why this is so good. You could just drop it, forget it, take your 38,000, 40,000 a year. And when you die, when the client dies, this annuity value goes to the beneficiary. So here's a way you can use your money without really invading your money, right? Now, if you bring this to a $50,000, well, that only leaves you 12% at age 100. So it's a big difference to take that extra 1% a year, about 10,000 a year, right? So at year 11 is when you're now, right? Now longer at 91, you're now 71 when you're invading your $1 million at 50,000 a year, right? So let's go to the next page here. Yeah, so at age 40, I should have had a red circle here, but it doesn't. At age 100 in the 40th year, you have 126,000 left. So 12%, right? So you can take 50,000 a year and never run out of money until you're about 102, 103, about 102 years old, right? A little bit over 102 years old. That is a 60-year-old, right? And this works for 60 and up because of the 10% excise tax rule on annuities. So you can't really do this at age 59. It won't work the same due to taxes and rules and restrictions. But let's say you don't take any money out. What's the minimum guarantee going to do? Well, 400% of your money. If you just let it sit at this minimum guaranteed interest rates, it'll be worth, as you can see, you match off in year 10. At the end of the surrender charge, you've made $597,000 or 59% of your money. And as you should see at age 100, not touching this, using just the minimum guarantees in this insurance contract, you have $4 million at age 100, should you live. And again, if you die, the accumulation, the annuity value goes to your heirs. And this other column here is the assumed column. That says, hey, if that thing never changed from 520 after the guarantee period, you'd have $7 million. So safe to say you're going to wind up somewhere between these two, because the odds of a company just giving you 3 the whole time, it's pretty low. They might come back in year 10 after the surrender charge with maybe a 4% rate. So, we're doing all this based on the minimum guarantees. It could be better. It could be better. So again, your death benefit is that column. Here are some information if you want to, my disclosures and stuff. But really, that kind of breaks it down. That's the end of my presentation. Yeah, so you can go through and hold all that. I should have had the actual illustration, all the pages for you to view. I didn't do that. So I may put a link in the description to a sample illustration so you can pull the actual client illustration. I'll put a link in the description to that. And you can look at the actual quote for that 38,811 annually. So yeah, that's how it works. So if you want to do it, there's insurance products. This company, by the way, is A rated, been around for a while. So they have A, excellent by AM Best. So you can put your money away, get some guarantees, not outlive it. And right now, the safe return where you get 100% of your money back or better, should you die before age 100, would be $38,811 per million. If it's $100,000, of course, it would be 10% of that, right? So and actually, interest rates change. So yeah, based on the million, that's it. Anyway, hope you all enjoyed that. Just an option that's available. No one really knows how strong these guarantees are right now. Minimum guarantees are super strong right now, and you should look at that. So anyway, that's the end of my presentation. Thanks for watching, and we'll talk to you all later. Bye-bye.